Hello everyone, this is the first chapter for EPFO for General Accounting Principles. Today is the first class. Today we will discuss basics of accountancy, the definitions, mandatory principles, types of accounting and accounting standards. After that we will discuss the basic accounting concepts. So let us begin. Firstly we come to the definition. Accounting is the process of identifying, measuring and communicating economic information. This permits informed judgments and decisions by users of information. So we see that there are three parts. First is identification of economic information, whether or not a transaction has any economic value. So mind that economic value is necessary. If something cannot be measured in economic terms, it will not be accounted for in the standard form of accounting. Second is measurement. Measurement means estimating or quantifying the value. For example, if I buy a 10 rupees chips packet, that has to be recorded as 10 rupees chips packet, not just a packet of chips. So quantifying the value of every transaction is important for accounting. And third is communicating. Communicating in this form means recording the statement in different books of accounts. So books of accounts we will study in later chapters. These are basically different forms of registers you might have seen in various shops, that they have a ledger, a cash book, a journal. So every transaction in accounts has to be registered in different books of accounts. Accounting information can be used by different users. It is used for economic decision making by the management, by the board of directors. It can be used for shareholding investment decisions as well as tax decisions by government. It can be used for valuation by consultancy companies, McKinsey, Bain, etc. you might have heard. So there are two kinds of users. Firstly is the internal set of users, which are the employees as well as management. And second is the external form of users, which are government, investors, etc. Alright, now we move forward to the next slide. There are three types of accounting primarily. The first is financial accounting. Financial accounting looks at the finances, the overall financial statements, by measuring the profit and loss, closing balances as well as opening balances. What was the position of any company or a going concern or a shop at the end of every financial year as well as at the beginning of every financial year. This also conveys financial information for longer term purpose, such as debt equity ratio, how much liability you have for debt towards equity. It also helps in tax authorities to assess how much tax to be calculated for any entity. Is this clear? Okay, now we move to the cost accounting principle. Cost accounting is basically measuring how much it costs to make a certain product. For example, if I have to make a bucket or a pipe, so first will be the raw material cost, then will be the processing cost, then will be the employee cost, and last will be the marketing costs as well as other operating expenses, right? So all of these will go towards the costs, and only after these costs are analyzed can we ultimately set the price, because if the price of any product does not cover even the costs, then it's going to lead to a loss. So the second form of accounting is cost accounting. The third form of accounting is management accounting. This is basically non-financial accounting. This looks at how productive an employee is. So productivity of employee, customer feedback, customer satisfaction, all of these come in management accounting. There are other forms of accounting also, such as social accounting, which the government can look at on the basis of how are different companies making decisions and how is it impacting society, but this is not important for the purpose of this course, so we will not delve into that. Okay, moving on to the next slide. Okay, so now we will start with the theory part of accountancy. So accountancy books have to perform certain features. They have to live up to certain expectations because there are different users of the economic information. What type of users did we discuss? We discussed internal users, the employees as well as management, as well as the external users, the shareholders, the tax authorities, government, etc. So for the benefit of all of these, there are some mandatory features of any accounting books. Alright, we will discuss what these accounting books are in detail in the coming lessons. For now, just know that all of these accounting books have to follow certain principles. I will just give you a brief hint, brief summary: cash book, journal, ledger, and balance sheet. These are the primary accounting books that we'll be dealing with over the course of this entire course. So the first principle that we have to look at is the principle of reliability. The information in the accounting books has to be completely accurate. If it is not accurate, then you can understand what will be the problem. It cannot lead to trust. So the absence of trust will lead to false information. This makes the accounting books irrelevant. Now we come to the second part, which is relevance. So only that information which has some relevance to the users has to be looked at. So every accountant has to understand who are the final users of the books of accounts. So whatever is being taken has to be recorded in that manner. For example, if a shopkeeper provides food for his employees, so he does not have to mention, if he is keeping food for employees, whether he bought pakoras, chai, etc., as long as he just measures food as one item in the expense category, and he can simply say, however, this is for a shopkeeper, right? For a restaurant, what food items were taken becomes relevant information. So relevancy has to be looked at depending upon who are the users of the information. And for the internal users, especially the management, you have to look at what is relevant depending upon the industry. Now we come to the third part, which is understandability. Okay. So the information has to be conveyed in a form that is clear, concise, and formatted. This will ensure that ultimately the readers of the information have access to actual unadulterated financial position. So maintaining the integrity of the account books requires that the person who is ultimately going to be using these account books not just knows that these are reliable and relevant information, but is also able to understand. So this means that you have to record every transaction as it is. If you received cash, you will have to record it as cash account being debited, not the 200 rupees being debited or UPI being debited. These will not do. You will have to debit the right amount and then mention the accountancy value. We will discuss how these books of accounts are prepared later on, but I am just giving you an example. Now, besides this, we come to the last principle for ensuring fairness of account books, which is comparability. This is the most important principle because a lot of accountancy concepts, which is going to be the main part of this video, are dependent upon the comparability principle. Comparability principle means that account books should be compared across industries. For example, the balance sheet of the pharmaceutical industry should be able to be compared to the balance sheet of a steel company. We can learn what are the different parameters that a steel company uses and what are the different parameters that a pharmaceutical company engages in to understand what are the differences between the two industries. Within the same industry, so the information that is supplied by two pharmaceutical companies, for example, should be comparable with each other, that what are the ingredients they are purchasing, how much they are paying for research and development, for marketing purposes. So their books of accounts should be in similar form. Third is across time. If in 1 year I maintain a cash book which shows how much cash I received and I paid and a balance sheet, and in the next year I only maintain a debt record, how much someone owes me or how much I owe to someone else, but I don't maintain a cash register and present a balance sheet, then it makes no sense, because in 1 year I have only accounted for the cash flow, and on the other year I have only accounted for the income earned but not the cash earned or kept. So this means that ultimately information across 2 years will not be comparable. So maintenance of the same balance sheet, the same information across multiple years is very important for the purpose of comparability. One more aspect that we'll discuss is within the same company, but we'll discuss it later. Within same company, we'll come to this towards the end of the class. So if this is clear, let's move on to the next part, accounting standards. So accounting standards are basically principles or rules which have to be followed for maintaining books of accounts. Maintaining books of accounts. What kind of transactions are you supposed to record? How much are you supposed to value something? What value will you involve? So what books, what value, what time. These are basically some of the rules that the accounting standards have to look at. So the most popular is the GAAP, the Generally Accepted Accounting Principles. These are a set of rules for accounting. This was started in the USA, but India's own Generally Accepted Accounting Principles were laid down by the ICAI. The ICAI has also laid down accounting standards. There are multiple accounting standards, AS1, AS2 they are called, which those who are studying for CA might be aware of, that every particular book has to be maintained according to different AS. The next set is the International Financial Reporting Standards, the IFRS. These are not rules, understand, these are not rules, these are only principles. So the GAAP was a set of rules. They provided what value. For example, they said historical cost is to be looked at, that the cost at which you buy something has to be the cost which is recorded. There is no deviation from the principle. The IFRS, for example, provides for the fair value concept. How is the fair value going to be arrived at? Is dependent upon the specific jurisdiction. Jurisdiction is any country which is supposed to apply these rules. So the IFRS is what is accepted across 167 jurisdictions, including the European Union. India has also come up with the National Financial Reporting Authority, under the Companies Act for implementing the IFRS in its own form. So the NFRA now replaces the ICAI's mandate. The ICAI is Institute of Chartered Accountants of India. Earlier it used to set the accounting standards, as we saw, but now the NFRA sets the accounting standards for companies as well as for other different accounting entities. So the ICAI now only conducts the exam for CA. Okay, if this is clear, let's move on to the next slide. So now we come to the concept of double entry bookkeeping. Double entry bookkeeping is the foundational method through which books of accounts are maintained. Double entry basically means that every books of account has two different categories. One is the liabilities side, the second is the asset side, and any transaction which has some effect on either of these two will ultimately be reflected through a debit or a credit on both sides. So if something increases our assets, it is debited. If something increases our liability, it is credited. However, if something decreases our assets, it is also credited, and if something increases our decreases our liability, it is also debited. Understood? So bookkeeping is the act of record keeping for financial information. We'll discuss the rules of debit and credit later on in proper depth in the next class. At present, it's only important to know what is double entry bookkeeping. So the bookkeeper is actually the original name for accountant, and in the ancient times it was called a bookkeeper only. This is based on the principle that every monetary transaction has a dual effect. This is the duality concept that we will learn later in this same class. This helps ensure accuracy of financial information and seamless flow of data, because if anything is measured on both sides, the debit as well as the credit side, ultimately it is reflected in a proper form across the final books of account in both the ledger as well as the balance sheet. So this leads to accuracy of information as well as seamless flow of data across multiple years. This originated with Middle Eastern traders. Luco di Borgo of Italy gave it the modern form by writing a book on this subject, on how to maintain double entry bookkeeping. Alright, now we finally move to basic accounting concepts. These are the 12 concepts which are the main crux of today's class. Now that we have sufficiently discussed the background of accountancy, we will move to what these principles are. These concepts are fundamental to the maintenance of books of account. This is different from the cautions that we originally discussed. You remember? Reliability, relevance, understandability, comparability. These are slightly different. These are the technical measures that are used while maintaining the books of accounts, but they are directly dependent upon these 4 cautions. Okay, so these are the 12 concepts that we will be discussing over the course of this class. The business entity concept, the money measurement concept, the going concern concept, accounting period concept, cost concept, duality concept, matching concept, as well as 5 conventions. Okay, so these conventions are also called concepts, but these are not the same as the previous concepts. We'll discuss their differences: the full disclosure, consistency, prudence and conservatism, revenue recognition and materiality. Okay, let us begin. First is the business entity concept. This means that the business entity is separate from its owners. Alright, so this means that a business is a separate legal identity altogether. While we maintain the books of accounts, we maintain it for the business, not for the owner. The owner is only a liability. The capital invested by the shareholders is recorded as a liability of the business, which will ultimately be paid back. Now you will see in the next principle how this is slightly contradictory to one of the other accounting concepts that we will be discussing, but we don't have to worry about it. Okay, the capital invested by a shareholder is a liability for the business and it will ultimately be paid back. Moving on to the next concept. The money measurement concept. The money measurement concept states that only those transactions which are happening in money terms can be recorded in books of accounts. On the other hand, transactions which can't be expressed in monetary units are not recorded, such as acts of kindness. If I tell someone that, listen, you're looking very good today, that is, or please take care, please go home early if you want to, that is only an act of kindness. That does not have any direct monetary impact, and as a consequence, it cannot be recorded in the books of account. On the contrary, any transaction which has economic value in monetary units, such as charity, if the business donates something to the people for advertisement or for genuine goodwill, all of these will be recorded because they have monetary value. They can be expressed in terms of money. But what about if the owner decides to pay some poor people or to organize a bhandara or food camps for certain people out of goodwill? Will that be recorded? No. Why? Because of the business entity concept, that the owner is separate from the business. This does not happen in real life. Most businessmen ordinarily ensure that anything that they do, all expenses that they take up, is recorded as a business expense. But in terms of integrity based financial accounting, we don't consider the expenses made by the owner as expenses of the company. So some examples that we will be discussing: appointment of a very efficient manager. This actually improves the financial performance of every company. Everyone knows this fact. In fact, shareholder also uses this information. However, it is not reflected in the books of accounts. A new competitor entering the market, this increases the losses or the possibility of loss for a business, but we will not account for it because this does not have direct monetary value. A rift between the production and marketing departments, the capability of human resources, etc. You are hiring very skilled labor, you are not hiring any skilled labor, employees are leaving at a very fast rate because of high attrition. All of these will not be recorded because they cannot be expressed in terms of money. This is the money measurement concept, that books of accounts are only concerned with economic transactions. Moving on to the third concept. This is the going concern concept. The going concern word, the word going concern normally means that companies businesses will go on, made out of one poem. It says that owners may come and owners may go, but company goes on forever. So this is basically the idea of a going concern concept, that the firm would continue to carry out its operations indefinitely. This allows for closing accounts to be prepared at the end of every year and opening accounts to be prepared at the beginning of the next financial year. Now this is where I had earlier pointed out a contradiction that we'll be seeing. Do you remember with the business entity principle, with the business entity concept, we had seen that the owner's invested capital is a liability for the business. It has to be paid back on some day. How will you pay it back if the firm will carry on indefinitely? This is merely a contradiction that is philosophical in nature. It does not impact how we prepare our books of accounts. These concepts are only to maintain accurate books of accounts. If we are to maintain books only on the basis of that what happened in 1 year, then we will not be able to record debt for multiple years, 3 years, or cash for 1 month accurately. As a consequence, we ensure that the going concern concept is applied so that we have timely, accurate information about financial data for any company, for any shop, or any sole individual or partnership. Okay, moving on to the next slide. Now we come to the accounting period concept. All books of accounts, be it the balance sheet, the profit and loss account, etc., have to be provided at regular intervals. Normally, while studying accountancy, we study it for 1 year. However, companies have to provide for quarterly as well as half-yearly reports as well. Public companies especially. Annual reports are discussed at big meetings such as the AGMs. So the accounting period concept ensures that through regular intervals we can have measurable information. This ensures comparability, which is one of the fundamental needs of any account book, because if we have information for 3 months in one go, and then we have information for 5 months and then for 4 months, then we don't know how exactly are we performing in each segment, because these are not comparable directly. If we have 4 quarters, then we definitely have a better comparison on which quarter provides for good returns, which quarter does not provide for good returns. So having any monthly, quarterly, annual assessment ensures that information is comparable. So this is the accounting period concept, that books of accounts have to be maintained for specific time frames. Okay, now we move on to the next accounting concept. The fifth concept that we will be discussing is the cost concept. The cost concept basically means that the price of all assets is to be, for the purpose of valuation in the books of accounts, have to be recorded at purchase price. So when we have to decide the value of any asset, we look at how much it was purchased for. And when we discuss how much it was purchased for, we discuss cost of acquisition, the crude cost that was paid. For example, if you purchased one machinery for 5 lakh rupees, then you paid 1 lakh rupees for transportation 20,000 rupees for installation as well as 30,000 rupees for cleaning or ensuring that its pipes etc. are connected, then the total cost that will be recorded is 6.5 lakhs. Understood? 5 lakhs, 1 lakh, 0.2 and 0.3. So all of these will together add to the capital cost. All of these costs together make up the purchase price of any asset that is to be decided. Suppose the same machinery 1 month later costs 13 lakhs in the market. Now what? Now suddenly do you change the entire value that is recorded? No. Market price at different dates is not recorded. What will be recorded later on is the sale price. If you decide to sell the machinery, then there will be capital gains on the sale of machinery. That can be recorded, but for all purposes, the purchase price in your books will be what will be the cost of the machinery. So if you buy it for 6.5 lakhs, then you will continue to show the machinery as 6.5 lakhs in value, even if its market price is different. Sometimes it happens that there are accounting standards on over the course of time, the value will go down. For example, there is a car. It might cost 30 lakh rupees. An expensive sedan might cost 30 lakh rupees when you buy it. But the moment you buy it, you cannot sell it for 30 lakhs anymore. So what we apply is depreciation. We will discuss this concept later on in another class in proper depth. At present, just understand that sometimes depreciation of value happens or appreciation of value also happens. Appreciation of value only normally happens for land, because over the course of time you might have purchased a land or a house for 25 lakhs. It could be worth 1 crore in modern day property prices. So appreciation also happens, but depreciation is the most common accounting activity that we conduct for most assets such as machinery, flooring, office equipment, etc. All of these face depreciation in value. So there are certain accounting standards which deal with how depreciation has to be recorded, and depreciation is recorded as a separate entry, recorded separately in the books of accounts as new transactions. So this will reduce the value of a machinery, but this will happen over the course of multiple years. Okay, so as we see, the general rule is only to record the cost price on at how much did you buy a particular product for. Moving on to the next slide. This is the most important concept in the entirety of double entry bookkeeping, the dual aspect concept. The dual aspect concept basically means that every transaction has a dual effect. We discussed it earlier also while giving the background of theory of double entry bookkeeping. This means that every transaction affects two accounts on opposite sides. These two accounts are normally maintained, one on the debit side and the other on the credit side. Okay, so the debit and the credit have to be equal. For example, if we purchase goods, now if goods are purchased, then cash will go out. So goods will increase in assets, so we will debit some goods and we will credit some cash because cash is going out for, let's say, 100 rupees each. So goods worth 100 rupees. Why goods worth 100 rupees? Because of the cost concept, that even if we bought 120 rupees of goods worth at 100 rupees, we will be recording their value as 100. If we bought if we paid 100 rupees cash, we will be recording 100 rupees of cash. What if the discount is measured? We'll discuss it later in a separate class. Please remember that both aspects are to be recorded. The general rule is that assets is equal to liabilities plus capital. Capital is also recorded on the liabilities side. So this is how a balance sheet ultimately becomes equal. That if think of it as a pot. If the owner puts 2 oranges and a creditor or a family member puts 3 oranges inside the pot, the total number of assets inside the pot are 5 oranges. So on one side you will only record 5 oranges. On the other side we will know that 2 from the owner and 3 from family. So the asset side has to be equal to the liability side ultimately. There are times when profits and losses have to be recorded for different purposes. For example, if we buy a machinery for 6.5 lakhs, we debit machinery to cash. We pay cash 6.5 lakhs. Now later on we sell this same machinery for 10 lakh rupees. What will happen? How will we record this transaction? Because there is more cash, there is less cost of machinery. For this we will do cash. If we get 10 lakh rupees to machinery 6.5 lakh and to profit and loss account. This is a profit because it's being credited. So profit and loss account 3.5 lakh. Ultimately both sides have to be equal. If 10 lakh are debited, 10 lakh have to be credited also. Okay, so this is the dual aspect concept. This is the basic foundational principle on which ultimately all double entry bookkeeping is done. Now we move on to the next slide. Now we come to the realization concept. Before this, I would just like to clarify that if you all think that my pace is too fast, please feel free to pause the video to understand a concept or to rewind. Don't be overwhelmed with the speed of the slides. This is going to be a big course altogether, which is why my speed is going to be slightly at a higher pace. But don't worry, the concepts we will cover over the course of multiple slides. These are only an introductory sessions. Ultimately we will be applying these concepts in multiple slides, so in multiple classes, so you will get a hang of it over the course of time. Don't worry. Okay, so we come to the realization concept. Realization concept is based on one basis of accounting, which is called accrual basis. Okay, there are two bases. One is the accrual basis and second is the cash basis. The cash basis of accounting says that only when you receive cash should you record a transaction. This used to be in the earlier times, ancient times, when money is what matters. Over the course of time, banks have grown, so record keeping is easier and more sophisticated. Contracts can now be enforced in courts, so there is less risk of what? Of debt default, कि कोई आपका पैसा लेके भाग जाएगा. That risk is very less. So as a consequence, we have moved to the major form, which is accrual basis. Accrual basis basically means that revenue from any business should be included when it is realized. So if I sell you goods on one day and you are to pay me 20 days later, even then I will record the transaction on the day when it is done, not 20 days later when you pay me. Okay. So this is the realization concept, that revenue from any business transaction should be included in accounting records only when it is realized. Revenue is said to have been realized when cash is received or right to receive cash on sale of goods or services has been created. So if I sell you goods and you are to pay me 20 days later, my right to receive cash has been created today itself. Therefore, I will record the transaction today. This also means, in other words only, when the obligation to receive the amount has been established. One should record revenue when it has been earned, not when the payment is collected. When the payment is collected, we will make a separate entry. Please understand. This helps in ensuring details of one accounting period are maintained within that period itself. For example, if I sell goods on 30th March or 29th March, but the payment is to be received 10 days later, how will I record this entry? And don't worry, I will be explaining how to record journal entries over the course of other classes. I am just giving you these examples so that if you are able to understand how double entry bookkeeping works. So if I sell goods on 30th March and they are to be paid for 10 days later, so my creditors is going up. So I will say creditors debit for rupees 100 to goods debit for rupees 100. This will be on 30th March, and then on 31st March I will make my balance sheet. The opening balance sheet over the course of the next financial year will have some creditors, and on 10th of April or whenever that money is paid, I will say cash debited rupees 100 to creditors. To debtors, I am so sorry, I made an error. Even in the earlier transaction it was debtors. Debtors are those जिनसे आपने उधार लिया है, who owe you money. Creditors are those who you owe money, जिनको आपको पैसा वापस लौटाना है. Please ignore this. The transaction is going to be, in the previous one it was debtors credited. Debtors are an asset to any company to goods, because goods are going down. After realizing, it becomes cash debited to debtors for the same amount, rupees 100. If the debtor is unable to pay, for example the debtor pays only rupees 90, then we also credit it to loss account. Then we also debit the loss. We get 90 rupees of 90 rupees of cash, 10 rupees of loss, and 100 rupees of debtors are being removed. So this is the realization concept, that at present we only record how much is realized. Okay. So one example that we can look at is, if A sells 100 barrels of oil to B on 10th Jan, it will be paid on 10th Feb, then revenue is realized on 10th Jan, whereas debt will become realizable on 10th Feb. Before that, if I claim the debt, the debtor has the right to say no, I will pay after 10th Feb. This is out of our syllabus. Okay, moving on to the next slide. Now we come to the matching concept. The matching concept states that expenses incurred in the accounting period should be matched with revenues during that same period. That it implies that all revenues earned during one accounting year whether received or not received during that year, and all costs incurred, whether paid or not paid, will be taken into account while ascertaining profit and loss of that year. So this is the reason why in the previous slide, even if we sell goods on debt, we have to maintain that there is a debtor for rupees 100 and goods have gone down by rupees 100, because our balance sheet has to reflect ultimately that there is a debtor as well as some goods. We cannot wait for cash to come in before we record a transaction. It has to be conducted in the same time period. It is also a part of the matching concept that both sides have to be equal across time. So as a consequence, this is a corollary of the accounting period concept and the duality concept. You remember a few slides ago, I had given the example of how we sell a machinery for rupees 10 lakhs, which was worth only rupees 6.5 lakhs. Remember? So we had also credited the profit and loss account for 3.5 lakhs. This ensures that whatever profit we have made will be made in that same accounting year. What if this P&L, this profit that we had made, was to be vested over 5 years? Then we would have to provide for provisioning. So some of it, while we receive cash, some will be machinery. If we receive cash for rupees 10 lakhs, machinery is sold for 6.5 lakhs, but the profit that we make has to be realized over 5 years. Then this year's profit is only 70,000, and provision or reserve is more used for ordinary amounts of money that we keep for future purposes, that will be credited with 2.8 lakhs. Understood? So the profit and loss for this year will only be what is meant to be taken this year and nothing outside of it. Moving on to the next slide. Now we come to the full disclosure concept. This is also a convention. Okay, this is not the same as the other concepts, because the other concepts had a direct bearing on how books of accounts are to be made. This is a guiding factor. This concept basically says that all material and relevant facts, material means important, relevant means which the users will consider valuable concerning the financial performance of an enterprise, must be fully and completely disclosed in the financial statements. This is a direct corollary of the reliability requirement that we discussed earlier. Full disclosure means that there should be full, fair and adequate disclosure of accounting information. In the absence of full, fair and adequate disclosure, it can lead to scams. If one might recall, there was a Satyam scam a few years ago where they had not disclosed the existence of some books of accounts and they had fake information about employees. This led to banning of the auditing firm that had conducted the audit because they did not record the fault that the Satyam company had made. Result also led to some arrests and a loss in the general investor confidence. So it is not just the company which suffers as a consequence of false information, it is also the entire market which suffers because everyone relies on financial statements, be it your competitors, be it your lenders, be it your vendors or your creditors, debtors, etc. Everyone relies on your financial statements. Therefore, full, accurate and fair disclosure of accounting information is very necessary. Now we come to the next concept. I hope this one was clear. This was very basic in nature, that you should be honest about your actual true financial position. We come to the next slide. This is the consistency concept. All the coming concepts are basically conventions in some form. They can be deviated from if there is a need, but they should not be deviated from, is basically the idea of having a convention. So consistency convention basically means that the same accounting principles should be used for preparing financial statements year after year. One should maintain consistency because it allows for comparison, which helps in the comparability of different accounting statements. As we had studied, all financial informations need comparability so that decision making as well as cost cutting is possible over the long run. So there are different types of consistencies. First is vertical consistency, wherein price of one asset within the organization should be same across different books of account. For example, if my machinery is 6.5 lakhs, then it has to be the same in cash book, it has to be the same in my journal and in my balance sheet. It cannot be that I say I paid 7 lakhs in the cash book and then I record only 5 lakhs worth of machinery in the final balance sheet. It has to be the same for every organization. Remember, if another company buys the same machinery for 10 lakh rupees, then this does not affect my position if I bought it for 6.5 lakhs. I am only concerned with one business entity. That is the business entity rule, the business entity concept that we discussed. The second consistency is horizontal consistency, that the same accounting books should be maintained over multiple years. So if a business is maintaining cash book, journal, balance sheet, trial balance, etc., all of these have to be for multiple years. This will ensure comparability across time. The third is more of a convention. It is not directly a concept that is mandatory. It is the dimension consistency, that similar trading organizations should have similar accounts. So if a rice mill, for example, has a mill machine for 20 lakhs, another same size rice mill should not ideally have one milling machine for 20 crore. Understand? Because that might mean there is a fraud, there is a lack of fairness. So overall, across the industry, if all entities have the same prices, we can generally come to terms on what is the standard industry practice in a particular industry. This is applicable for all industries, be it trading, be it airlines or any other industry, the same principles are followed. Understood? We move on to the next slide. This is the 11th concept. Sorry for the numbering. The materiality concept, that only material facts which are important as well as relevant information should be supplied to the users of accounting information. The materiality of a fact depends upon its nature as well as the amount involved. So, any fact would be considered material if it is reasonably believed that its knowledge would influence the decision of informed users of financial statement. For example, money spent on food, as we had discussed earlier, money spent on food for employees can be recorded. It is not relevant what the food was which was eaten. If you spend ₹1,000 every day consistently for 10 employees lunch, then that is not a problem. However, if one fine day you spend 1 lakh rupees on a single day for the same 10 employees, then you have to specifically record. Why? Because it's not just the nature but also the amount which is involved. So if you are using a very high amount, then it is better that you record whole transaction. This makes your entire books more fair. Whenever I say books, please understand it is obvious that I only mean books of accounts. This is not fiction or non-fiction books that I am talking about. So, for the fairness, for reliability, for relevance, we will have to work on the materiality concept. This is also a convention. Okay. Now we move on to the last of all. This is the prudence principle or the conservatism concept. The prudence principle basically says anticipate no profit but provide for all possible losses. Anyone might say this is a horrible way to do business. This is very pessimistic in nature. This is against all hope, because you are suddenly anticipating that you will never make profit, but you will provide for all losses. If I am only going to make losses, then why be in business? I am in business to make profit. I am not in business to make losses. The point is that only through this idea of prudence can we ultimately maintain fair accounts. You make provisions for losses so that in case there is a loss, you have that covered for. Obviously there is going to be a profit. It is always good that there is a profit, and when the profit happens, your balance sheet will grow over the course of many years. If you show consistent profit, this will anyway improve credit worthiness. But in case if you don't make provisions, then whenever there is a loss, you will be caught off guard. That is not something that any business wants to afford. As a consequence, we provision for all losses and we anticipate no profit. This keeps us grounded in reality. There is a poem by हरिवंश राय बच्चन. उसमें एक लाइन आती है कि स्वप्न पर ही मुग्ध मत हो, सत्य का भी ज्ञान कर ले. That ultimately, please be grounded in reality that there is a possibility of losses also. So be grounded and ensure that if there are profits, you can be happy later on, but the business has to anticipate. So we make different provisions for losses, be it provisions for NPA, provision for depreciation, provisions for fire, etc. We keep certain provisions. This allows us to balance our losses over multiple years instead of one single year. For example, banks make provisions for non-performing assets. They don't account for early payment of loan because of the conservatism or the prudence principle. This is basically the 12th set of accounting concepts that we have studied. So with this, we come to the end of the theory part of today's class. After this, we will discuss the various PYQs, previous year questions that have come in the last two EPFO exams. So today we discussed the definition of accounting, that it is the act of identifying, measuring and recording or communicating any financial information. We discussed different forms of accounting, be it financial accounting, cost accounting or management accounting. We discussed different accounting standards, the generally accepted accounting principles, the international financial reporting standards, as well as the establishment of the National Financial Reporting Authority, the NFRA, by India for setting up accounting standards for Indian companies. We also discussed what are the key features of any books of accounts. They have to be reliable, they have to be relevant, they have to be understandable and they have to be comparable over time. We also discussed that there are different accounting concepts, these 12 accounting concepts that we discussed. So these are basically the crux of what today's class consisted of. Please have a look at the basic accounting concepts, the business entity concept, that all businesses have to be treated as a separate entity from their owners. The owners are not the business and the business is not an owner. The owner's investment is only a liability for the business. The second is the money measurement principle, that any information or transaction which does not have economic value will not be recorded in the books of account. Hiring of a very productive manager, entering of a new competitor in the market, loss of productivity of employees, all of this will not be recorded, whereas anything which has transactional value will be recorded in the books of account. The third was the going concern principle, that the business will continue to go on for the foreseeable future. It will not end. The fourth was the accounting period concept, that books of accounts have to be maintained for relevant periods of time at regular intervals. So be it quarterly, be it half yearly, be it annually, but books of accounts have to be made at regular intervals and not upon the whims and fancy of the accountant. The fourth was the cost principle, that the cost concept says that whatever cost you purchased an asset for, that cost has to be recognized. The sixth was the dual aspect principle or the duality concept, which says that every transaction has one debit side and one credit side. Then we come to the matching concept, that both the sides have to match, the debit and the credit have to be equal to each other ultimately. And then we come to certain conventions, which were the full disclosure convention, the consistency concept, the conservatism or the prudence concept, the revenue realization concept and the materiality concept. The full disclosure concept says that fair value has been recorded. Consistency says that same accounts have to be maintained. Conservatism says all losses to be recorded, provisioned, and no profits to be anticipated. The revenue recognition principle says that whenever revenue is realized, not when the payment is received, then you will record it. And the materiality principle says that all important transactions have to be recorded. So these were the 12 accounting concepts that we discussed today. Now we will move on to the previous year questions. All right. So we discussed the first PYQ. What is the underlying accounting concept that supports no anticipation of profits but provision for all possible losses? Please take a guess. Okay, so as we discussed, it is the conservatism or the prudence principle. Prudent person, as we know, is someone who applies modesty, who does not take too much risk. And conservatism, a conservative person is also someone who is not very radical in their mindset, who go very slow, who ensure that they account for all the bad things. So this is what the conservatism concept is about, and this is the correct answer. Moving on to the next PYQ. So which one of the following accounting concepts is applied by an entity when events such as new competitor entering the market or rift between production and marketing departments are not disclosed in books of accounts? तो अगर कोई नया competitor enter कर गया या फिर प्रोडक्शन और मार्केटिंग डिपार्टमेंट के बीच में लड़ाई हो गई, झगड़ा हो गया, दे डोंट अग्री ऑन द सेम प्राइस, ये सब हम लोग बुक्स ऑफ अकाउंट्स में नहीं रिकॉर्ड करते हैं. व्हाई इज़ दैट? बिकॉज ऑफ विच प्रिंसिपल वी हैड डिस्कस्ड? दिस इज बिकॉज ऑफ द मनी मेजरमेंट प्रिंसिपल. ऑल राइट, मूविंग ऑन टू द नेक्स्ट प्रीवियस ईयर क्वेश्चन. In case of gold, revenue is recognized in the accounting period in which the gold is the answer is mined. Why? Because the asset becomes realizable when gold is mined. This is a very specific concept from mining, that when the asset is mined, it is realized. The asset is sold at a later date. The same is existing for crops also and for other entities also, that when the asset comes into existence, it becomes realized. Okay. Now we come to the next PYQ. This is the last PYQ for the day. In context of accounting, the term IFRS stands for A. International Financial Reporting Standards, B. Indian Financial Reporting Standards, C. Indian Financial Reporting System, or D. Indian International Financial Reporting System. We had discussed in this class that IFRS stands for International Financial Reporting Standards. So the answer is A. Okay, so with this we come to the end of the first class. We will be discussing accounting principles and the basics of account books, financial statements such as trial balance, balance sheet, etc. over the course of the next two classes. All right, have a good day.